it really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And I mean, Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane.
And I would say this in terms of predictions, and I know the spirit in which you asked the question, but there's a market out there all the time, and people love to hear predictions. I mean, if I said I was going to offer a bunch of predictions today, I mean, we would have 1 million people here. I mean, they're dying to have predictions, and speeches at Rotary clubs or trade associations or whatever. They just plain love it, and that's what a whole industry is built upon. The people coming out of Washington that talk about political predictions, and I don't read those in the paper at all, because it's space fillers basically. And you mentioned Edgar Casey. Ben Graham knew Edgar Casey pretty well, but I just have never seen any utility to any of that at all. There will be some huge surprises in the world. There's no question about that. But I don't think that betting on any specific one is a very smart policy. In fact, we usually bet against them in terms of super catastrophes. We know there will be a 7.0 or greater quake in California in the next 50 years. We don't know where it'll be or when it'll be or anything like that. We're willing to pay out a lot of money if it happens tomorrow. And because people do worry about catastrophes, and in this case it's perfectly proper with insured values, but it just isn't any way, in our view, to get through economic life. Charlie?
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money, and he went broke a couple times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments, and he did very well. It's an interesting history. But if you look at the whole history of them, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
I've not earned any stars for my past economic predictions, and the good thing about my economic predictions, if I even do make them, is that I pay no attention to them myself. So I really, and the way we pick our investments is we just don't get into the macro factors. I can't recall a time when Charlie and I have looked at a business, either buying it in its entirety or buying pieces of it through the stock market. Macro conclusions are just never enter into the discussion. I mean, I'll pick up the phone. We've had these two in recent months, and I'll tell Charlie about it. And we talk about a few things, but we don't talk about anything remotely macro. And that's really the way it'll stay. I've seen a lot of bank mergers recently, and one of the things they do, because they want to cut the costs and justify a merger, which they're dying to do. I mean, that's the reason they cut costs they wouldn't have cut if they weren't dying to do the merger in the first place and get bigger. But frequently, I know one in particular that I'm thinking of, that they'll cut out the economics department. I always wonder why the hell they had it in the first place. Because what do they do? I mean, the guy comes in, I says, I think GDP will be 4.6 this year instead of 4.3. So what? You know, I mean, you're still trying to make every good loan you can make, and you're still trying to take in deposits as should be trying to cut costs wherever you can. It's got nothing to do with running the business. But you know, it's fashionable. And every bank had its economist and economics department, and when a big client would come in, they take them to lunch, and it always has struck me as it's just a lot of nonsense. You know, so if we ever get a economics department at Berkshire, sell the stock short.
There was one other item in here, I believe, which I think achieved a little added relevance in the last year. I said, we therefore need someone genetically programmed to recognize and avoid serious risks, and then I put in italics, including those never before experienced. And then I said, certain perils that lurk in investment strategies cannot be spotted by by use of the models commonly employed today by financial institutions. Well, I think that proved to be somewhat prophetic of what happened last year. All of these places had models. I mean, the major banks, the major investment banks, and they would meet weekly at a risk committee probably and go over their models, and all of the statistics would be printed in nice columns and everything. And they didn't have the faintest idea what risks they were involved. You really need, in the investment world, someone very solid, someone you trust, reasonable analytical skills, but you also need someone that actually can contemplate problems that haven't popped up yet, but which are starting to become possibilities in terms of new financial instruments or new behaviors in markets and that sort of thing. And that's a rare quality. I mean, that inability to envision something that doesn't show up in your past model, you know, can be fatal. And Charlie and I spend a lot of time thinking about things that could hit us out of the blue that other people don't include in their thinking. And we may miss some opportunities because of that, but we feel it's essential when managing other people's money, or for that matter, managing our own money. So I would say that you might go back and read the 2006 annual report again, but those are the criteria we're looking for, and we have identified as being met by the four people we're thinking about. Charlie?
Yeah, you can see how risk averse Berkshire is. In the first place, we try and behave in a way so that no rational person is going to worry about our credit. And after we've done that, and done it for many years, we also behave in a way that if the world suddenly didn't like our credit, we wouldn't even notice it for months. Because we have such liquidity and are so unlikely to be unable to be pressured by anybody. That double layering of protection against risk is like breathing around Berkshire. It's just part of the culture. And the alternative culture is just the opposite. You call a man the chief risk officer, but often he is functioning as a guy that makes you feel good while you do dumb things. So he's like the Delphic oracle that convinced the Persian king to attack somebody or other. I mean, he's just a dumb soothsayer. And how can a guy be dumb when he's got a PhD and he can do all this advanced math? Well, you can but you can. It's perfect. Well, all you've got to do is crave system and computation so much that you torture reality into fitting some model, mathematical model, which really doesn't match, particularly under extreme conditions. And then because of this work that you're putting into everything and these computations about daily trading risk and so forth, you feel confident that you've clobbered the risk, but you haven't. You've just clobbered up your own head.
Yeah, we really want to run Berkshire You know, I'll even applaud that one. We really want to run Berkshire so that if the world isn't working tomorrow the way it's working today, and it's working in a way nobody expected, that we don't have a problem. We do not want to be dependent on anybody or anything else, and yet we want to keep doing things. So we think we found a way to do that. It may give up some of them. Well, obviously gives up earning higher returns 99% of the time, and maybe 99.9% of the time. Obviously, we could have run Berkshire with more leverage over the years than we have, but we wouldn't have slept as well, and we wouldn't feel comfortable. We have a lot of people in this room that have almost all their net worth in Berkshire, including me, and we wouldn't feel comfortable running a business that way. Why do it? I mean, it just doesn't make any sense to us to be exposed to ruin and disgrace and embarrassment and for something that's not that meaningful. If we can earn a decent return on capital, what's an extra percentage point? It just isn't that important. So we will always try to behave in a way that A, is not dependent on anybody else evaluating the risk except for us. It cannot be farmed out. And you've seen what happened to some institutions where the management thought they were farming it out. And if that means a reasonable return instead of a slightly unreasonable return, we just accept it. Number two.
Hello, Mr. Buffett. Hello, Mr. Munger. My name is Burkhard Wittek, and I'm from Munich, Germany. I would like to get back to your point that as a professional investor, one should be able to act quickly and decisively. That means being able to know what the intrinsic value is and to act within a day or within an hour if the market offers an opportunity. My question is, how large is the universe of companies which you have in your head whose intrinsic value where you would be able to act within a day or two if the market offered an attractive price to you? And secondly, how come you suddenly invest in Southern Korea or China?
Yeah, we can act. Our immediate decision is whether we can figure what's being offered out to us or not. I mean, there's a go, no-go signal, and Charlie and I are often thought to be rude when we think we're just being polite and not wasting the other person's time. So as they start mid-sentence in their first conversation with us, we just say, forget it. And Charlie's pretty good at that, and I'm picking it up. We know very, very, very early in the conversation whether somebody's talking about something that there's any chance is actionable by us. And we don't worry about the ones we miss. We want to make sure that we don't waste any time thinking about things that when we get all through thinking about them, we're not going to know enough to make the decision on. So we just rule those out. And that rules a lot of things out. Then if it gets through a couple of these filters and makes it into an area where it says this is something that we know enough about to make a decision on, we're ready to move right then. So we make decisions. We can make a decision in 5 minutes very easily. I mean, it just is not that complicated. Now, we know about a number of businesses and industries, and there's a lot of businesses and industries we don't know anything about. We know about a lot of things about certain kinds of bonds, and we know some. There's a variety of things we know about, and it's nice if we can expand that universe of knowledge. But the most important thing is that anything that gets through is in an area of knowledge. And the truth is, if we can't make a decision in 5 minutes, we can't make it in 5 months. We're not going to learn enough in the following 5 months.
Warren Buffett emphasizes the importance of ignoring public opinion when making investment decisions. He highlights that the stock market is filled with various opinions, with people constantly buying and selling shares. Relying on others' thoughts about stocks, such as Coca-Cola or Gillette, can lead to poor decision-making. Instead, investors should focus on evaluating businesses themselves and making decisions based on their own analysis. Buffett asserts that public opinion polls will not make one rich on Wall Street, and those who rely on them should reconsider their investment strategy. Buffett argues that making investment decisions based on economic predictions or market forecasts is futile. He points out that there is a constant market for predictions, with people eagerly seeking out forecasts and analysts' opinions. However, he believes that such predictions hold no real value and are essentially just fillers in the media. Instead of relying on predictions, Buffett advises focusing on the intrinsic value of businesses and making decisions based on a solid understanding of their fundamentals. According to Buffett, economists and analysts who spend their lives studying economic variables and making predictions rarely achieve significant wealth from securities. He cites the example of John Maynard Keynes, who initially tried to predict economic cycles, but eventually shifted to a value-based investment approach, which proved more successful. Buffett stresses that making money in the stock market requires understanding and investing in good businesses rather than attempting to predict market movements. Buffett shares that he and his partner, Charlie Munger, do not base their investment decisions on macroeconomic factors. They avoid getting caught up in discussions about the economy or market trends and instead focus on the specifics of the businesses they are considering. By ignoring macro factors, they ensure their investment decisions are based on solid business evaluations rather than speculative predictions. Buffett highlights the importance of recognizing and avoiding serious risks in investment strategies. He mentions that many financial institutions rely on models and statistics to manage risk, but these models often fail to account for unforeseen events. Buffett and Munger spend considerable time contemplating potential risks that others might overlook, ensuring that their investment decisions are robust even in the face of unexpected challenges. Buffett criticizes the role of chief risk officers and the reliance on mathematical models in financial institutions. He argues that these models can create a false sense of security and lead to poor decision-making. Instead, Buffett advocates for a more cautious approach, emphasizing the need for individuals who can envision and prepare for potential problems that are not evident in existing models. Buffett explains that Berkshire Hathaway operates with a strong emphasis on liquidity and independence. They aim to ensure that the company is not dependent on external evaluations of risk and can withstand unexpected economic changes. This approach allows them to avoid being pressured by market fluctuations and maintain stability even in uncertain times. Buffett discusses the importance of making quick and decisive investment decisions. He and Munger can often determine within minutes whether an investment opportunity is worth pursuing. They focus on areas where they have sufficient knowledge and avoid wasting time on opportunities that they cannot thoroughly evaluate. This efficiency allows them to act swiftly when they identify attractive investments. Buffett highlights the need for solid analytical skills and the ability to foresee potential risks in the investment world. He believes that having someone who can contemplate and prepare for problems that have not yet occurred is crucial. This approach helps Berkshire Hathaway avoid catastrophic losses and ensures that their investment strategies are resilient in the face of unforeseen challenges. Buffett concludes by emphasizing the importance of maintaining a reasonable approach to risk and return. He acknowledges that while Berkshire Hathaway could achieve higher returns with more leverage, they prioritize stability and security. By avoiding unnecessary risks and focusing on solid business fundamentals, they ensure long-term success and protect their investors' interests. This conservative approach reflects Buffett's philosophy of achieving steady, sustainable growth rather than chasing short-term gains.